Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. Reliance Industries. It's the heavyweight anchor of the Indian stock market, a conglomerate spanning oil, retail, and telecom. But recently, something rattled the markets. Reliance shares slid down to hit a fresh 52-week low. For a stock that usually commands a heavy premium, this drop has caught everyone off guard. Is this a fundamental breakdown of India's biggest corporate giant, or a classic perfect storm, creating a lifetime buying opportunity for long-term investors? Today, we are breaking down the financials, the secret details from their latest conference call, and the massive future plan that could double their profits by 2027. Let's dive in. The financial reality check. To understand the drop, we have to look at the numbers. On paper, Reliance's full-year performance looked solid, but the market looks forward, not backward, and the recent fourth quarter earnings threw up some massive red flags. Look at this divergence. Reliance managed to grow its quarterly revenue by a robust 12.9%, hitting over 3.25 lakh crore rupees. But its net profit? It plummeted by 12.6% to 16,971 crore rupees. Why did higher sales lead to lower profits? Because their core EBITDA margin compressed by a steep 200 basis points, down to 14.9%. When we break it down by segments, the culprits become obvious. The legacy oil-to-chemicals, or O2C business, took a major hit. Global refining margins softened, and geopolitical tensions in West Asia sent freight and insurance costs skyrocketing. Meanwhile, even though Reliance Retail grew its footprint past 20,000 stores, its net profits remained completely flat. Why? Because scaling up their new hyperlocal and quick commerce divisions required heavy cash burn. The only shining star was Jio, which maintained a stellar 52.4% margin with an ARPU climbing to 214 rupees. Hidden details from the conf call. But the real story isn't just in the profit and loss statement. In their recent analyst conference call, management addressed these pain points directly. First, they clarified that the drop in reported net profit is heavily driven by non-cash accounting elements. Reliance has completed its massive 5G network rollout, which means they've started capitalizing those assets. This front-loaded a massive wave of depreciation and finance costs onto the balance sheet. Second, they addressed the clean energy segment. Rumors of regulatory delays and PLI penalties had spooked the market. However, management confirmed that their advanced battery storage factory is in its advanced commissioning phase. Even better, they have officially shipped their first 200 megawatt peak batch of high-efficiency solar modules from their Jamnagar Giga-complex. The 2027 Masterplan. So, what is the road ahead? Reliance is executing a massive corporate transition from a legacy industrial giant into a deep tech, green energy powerhouse with a target to double its consolidated EBITDA by 2027. Here are the three massive catalysts on the horizon. 1. The Jio IPO. Reliance has initiated the roadmap to list Jio platforms at an anticipated valuation of $110 to $120 billion. This will act as a massive value unlocking trigger and erase any remaining balance sheet debt. 2. The sovereign AI push. They've launched Reliance Intelligence, partnering with Meta and Google Cloud to deploy open-source AI models across India, turning Jio from a telecom utility into a high-margin software platform. 3. The clean energy monopoly. Their Jamnagar complex is shifting to vertical integration. By controlling the complete supply chain from sand to electrons, Reliance aims to produce the world's cheapest green hydrogen within the next 5 years. Valuation verdict. This brings us to the ultimate question. Is the valuation attractive right now? If you are a short-term trader, caution is warranted. Reliance is a heavy component of the Nifty 50, meaning it will face pressure as long as foreign institutional investors keep pulling capital out of emerging markets. But if you are a long-term investor with a 3 to 5 year horizon, the valuation has entered deep value territory. The stock's trailing price to earnings multiple has compressed to a 5-year low of around 20 times. At this current price, you're essentially buying Jio and retail at market multiples and getting their legacy oil empire and their entire multi-billion-dollar green energy infrastructure virtually for free. Reliance is currently enduring a heavy reinvestment phase. The heavy lifting of capital expenditure is mostly done. And as these new factories and IPOs go live, the earnings power will likely return with a vengeance. What are your thoughts on Reliance Industries at a 52-week low? Are you buying the dip or waiting for lower levels? Let me know in the comments below. Don't forget to like this video, subscribe to the channel for more deep dives, and hit that notification bell. See you in the next analysis.